I'd like to thank everybody for joining us today, and we really appreciate you taking time out of your busy day to attend this event. Also like to thank the Greater Westchester Chamber of Commerce, Katie, Maggie, Dot, and Mark for taking your time to organizing this event for us and allowing Arthur Hall the opportunity to sponsor the moodyseconomy.com luncheon. The Chamber really does a great job organizing these different events for the members, so we really want to thank them, and it's always a pleasure to work with you guys. Just want to take a quick moment to give you some feedback and information about our agency. Arthur Hall Insurance is an independent agency. We provide risk management solutions to businesses, organizations, professionals, nonprofits, and families. We were established in 1966 in Westchester, Pennsylvania. Our commitment to excellence and developing long-lasting relationships with our clients has really allowed us to grow in a multi-state organization. We have local processing offices in Westchester, Pennsylvania, and Mount Shannon, Delaware, and with a staff of 23 employees. We are a full-service insurance agency, so we can provide and assist you with all your insurance needs, such as personal insurance, commercial, and benefits. When you place your trust in Arthur Hall Insurance, you're really working with an insurance advisor that has your best interests at heart. We access multiple insurance providers on your behalf. We present and recommend different insurance programs that have your best interests at heart and also have the right policy and coverages that fit your needs. So we just want to thank you again for attending. At this time, I'd like to introduce Marisa Natale. She is the director at moodyseconomy.com, and she has been doing this presentation for us for the last 3 years. And Marisa really does an excellent job, and she really helps us forecast, our agency goals for the following year. So thanks again, and now I'd like to introduce Marisa.
Thanks, Nicole. Thank you to everyone. It's nice to see everyone again. I promise I'm going to be a little more uplifting this time. Okay. I think the last time I spoke to you was in January, if I recall correctly. So a lot has changed since then, and I think a lot of it for the better. Although it's still not a entirely rosy picture. So what I'm going to do, like I've done in past talks, is start off with the national economy, and from there work our way down to the regional economy. Just to give you the big picture, just to put everything into context, we're going to start off looking at how the recession has played out. We think that the recession probably officially ended in August. You may know that there is the National Bureau of Economic Research. They are the official recession dater. This is a group of professional economists and academics that come together, and usually many months after a business cycle has started and ended, they'll look at various indicators and they'll pick a start date and an end date to the recession. I think when they look back on it, this time they'll probably say that the recession ended in either August or September. What this means is that pretty much by every major economic indicator, every measure that you can look at of this recession, this is by far the worst since the Great Depression. What's shown here in this chart is every single recession since World War II, essentially. And we're looking at the length. The length of the recession from the peak to the trough was 20 months, which is just about double the average length of recessions prior to that. You look at the downturn in GDP from peak to trough, the downturn in employment, the downturn in industrial production, all by every single one of these measures. This is the most severe by far that we've seen since the 1940s. You look at the rise in the unemployment rate. The unemployment rate at this point has more than doubled from the low that it reached at the end of 2006. It reached a low of 4.4%. This is nationally. And you may know that in October, when the data were released a few weeks ago, the national unemployment rate rose to 10.2%. So we've blown through the double digits. Many people, a year ago, were forecasting a peak unemployment rate of 10% at the highest. So we've gone through that. And pretty much by any other measure, if you obviously the housing market, home building, home sales, home prices, building permitting, all of this is reached historical lows during this recession. Now, when I say that the recession's over, that probably provides little comfort to a lot of people, because if you look at other indicators of economic activity, they haven't recovered much at all, and in particular the labor market. And we'll talk a little bit about that. So this end to the recession is really a technical end to the recession. You may know that GDP growth turned positive in the third quarter of 2009. It grew by about 3.5% on an annualized basis. This was the first quarter of positive GDP growth since the recession began. So this is the main reason why we think the recession will be declared over in that quarter. Much of the contribution to GDP growth, and I'll talk about this a little more yesterday, was due to the federal economic stimulus and all the money that came in because of that. Without the stimulus, GDP growth probably would have been slightly negative. And then we also have a big inventory swing coming along. Businesses, especially manufacturers, had so cut down on production and were sending out all their orders out of existing inventory that they drew down so low that they've actually started to have to ramp up production recently just to fulfill new orders. So two things going on there, neither of which to probably the average American means very much, especially with a 10.2% unemployment rate. So we'll talk about that a little more. But first I want to talk about how this sort of has calmed down over the past year since I last talked to you. What I'm showing here is what's called the TED spread. This is a measure of, I guess you could say, perceived risk in the banking system. So this is the spread on 3-month LIBOR over 3-month Treasury bills. So the 3-month LIBOR is usually the interest rate that banks charge one another for short-term lending. So if you look at that over a risk-free rate, which is the government T-bill, you can see how that spread widened at the height of the financial crisis. This was last fall when you had Lehman Brothers go under, you had AIG taken over by the government, and you had the government take over Fannie and Freddie. This was sort of the height of the financial crisis. And you can see at that point, the 3-month LIBOR was about 4.5 percentage points above the Treasury bill, which was going back, you have to go all the way back to this data begins to even see a spread like that. In terms of the risk, the perceived risk in the banking system. And what's remarkable is how it's come down since then. And a lot of that has to do with the efforts by the Federal Reserve to intervene and to stem the crisis, both to buy up some of the bad debt, to get some of the credit markets working again, to lower interest rates to historical lows, to spark a little bit of demand in the housing market on the mortgage side. We have this federal government intervention as well. We have the first-time homebuyer tax credit, which has juiced up home sales over the past couple of quarters. So there's been a lot of hand-holding, unprecedented involvement by both the Federal Reserve and the federal government that's helped to bring down this sort of angst in the banking system.